short and long and etc. And which markets people are likely to go short and long is an easy one to answer. In commodities, indices, and currencies, people are as likely to be long as they are to be short. In fact, actually, you can't actually be long or short of a currency or a currency pair, because if you're long sterling dollar, that means you're long the pound, but it means you're also short the dollar. So, what are you? I'm long the pound. I'm short the dollar. So clients are just as likely to be long as they are to be short in those markets. When it comes to single stocks, there has only ever been one day in the entire history of London Capital Group when the clients were net short of equities. And I think that was the 14th of March, 2009. And that was the low point. The actual low point was the only day. And that was when the clients were the last lot of longs were stopped out. So the only people left were the people who were short. But in reality, on individual stocks, clients are nearly always long of stocks. Okay, of course, you'll have individual stocks, like a lot of people are fond of shorting Ocado and things like that. But in general, they're long. That's the choice of the client. But I would, as I say, I would never, any individual position, I would never risk more than 10% of my margin on of the funds on my account on any particular position. Anywhere between 3 and 10%, depending on your risk criteria. If a company issues a profit warning, you have to look at the reason for the profit warning. If it's a one-off event that was beyond the company's control, then you say, well, fine, I'll take that on the chin, hold on to it. But if it's sort of something like, poor trading conditions or the cost of doing something was more than we were expecting or something like that, then you've probably got to say, well, actually the management's probably not up to scratch. So take it on the chin, cut the position, get out and move on to something else.